Okay, let's just dive right into this explainer on Bollinger Bands. Listen, if you've ever looked at a stock chart and felt like you were literally staring at pure chaos, well, you are definitely not alone. But today, we're going to explore this totally fascinating tool. It essentially sets up mathematical guardrails to make sense of all those crazy market prices. We're talking about transforming those random, jagged zigzags into an actual, understandable story of human emotion and statistics.
So here's our roadmap for today. We're going to kick things off with, is the price right? Then we'll look at the anatomy of the bands, dive into the 95% rule, talk about spotting extreme market events, and finally wrap up with what happens when statistics meet reality. Let's get to it.
Is the price right? Let's start right off with a core dilemma that has honestly plagued investors since the very dawn of financial markets.
Is a stock currently expensive or cheap? I mean, it sounds like a simple enough question, right? But because stock prices are just constantly fluctuating, trying to figure out if a price is objectively high or low in a vacuum is incredibly tough. Think about it. A price of, say, $100, that might be an absolutely massive peak for one company, but a total rock-bottom bargain for another. Absolute numbers just don't tell us the whole story here. To solve this exact problem, a financial analyst named John Bollinger came up with this brilliantly simple solution back in the 1980s. He realized, to really understand price, you've got to define a reasonable boundary for its fluctuations. He basically theorized that stock prices aren't just moving completely at random. They actually act kind of like a pendulum, swinging around a central average value. So to figure out if a price is truly high or low, we just need to measure how far it's swung away from its recent average.
Moving on to Section 2, Anatomy of the Bands. So how do we actually map out that swinging pendulum? Let's break down the visual tool he created.
Breaking down his solution, we get three beautifully logical lines. First, the middle band acts as the trend's spine. It's the 20-day simple moving average, which just represents the average cost over the last month. Then we've got the upper and lower bands. Now, these aren't just your standard parallel lines. They are dynamically calculated by adding and subtracting exactly 2 standard deviations from that middle spine. And because they use standard deviation, these outer bands continuously expand and contract. It's almost like they breathe in and out right along with the market's actual volatility.
When you compare them, you see exactly how traders intuitively use these mathematical boundaries in the real world. The upper band acts as this dynamic ceiling. When prices hit this ceiling, the asset is typically considered overbought, and selling pressure usually starts to mount. On the flip side, the lower band acts as a floor. When prices crash down into this zone, well, it's viewed as oversold and buyers start sniffing around for a rebound. It effectively creates this visual envelope of support and resistance that literally shifts right along with the market's momentum.
Okay, Section 3, the 95% rule. Let's see how all of this builds on a really specific and super powerful statistical foundation.
So the absolutely crucial takeaway here is this single number, 95%. According to the normal distribution of data, which, you probably recognize as the classic bell curve, roughly 95% of all price action should, theoretically at least, stay locked right inside these bands. By setting those outer limits exactly 2 standard deviations away from the average, Bollinger basically created a statistical containment zone. If a stock is following normal mathematical probability, 95 times out of 100, its daily closing price is going to end up somewhere between that ceiling and that floor.
Let's quickly clarify why standard deviation is really the secret sauce here. Unlike fixed percentage bands that just stay totally rigid, standard deviation actively measures the market's panic and greed. When the market is super calm and prices are clustered tightly together, the standard deviation is small, so the bands kind of squeeze together. But, man, when unexpected news hits and prices start swinging wildly, that standard deviation spikes and the bands widen way out to accommodate all that chaos. By dynamically multiplying this measurement by 2, it ensures our 95% containment zone is always perfectly right-sized for whatever mood the market happens to be in.
Moving to Section 4, Spotting Extreme Market Events. Armed with all this math, let's look at how traders actually use this visual envelope to hunt for opportunities. There are 3 major setups that traders are always on the lookout for. First up is mean reversion. That's basically betting that a price poking outside the bands is just this extreme anomaly that's absolutely destined to snap back to the middle. Then you've got the squeeze. This happens when volatility just totally dries up and the bands pinch in super tight. It's kind of like the calm before the storm, usually warning that a massive breakout is looming. And finally, there's riding the band, which is when a really strong trend refuses to snap back and instead just walks right up the ceiling or straight down the floor.
And this chart brilliantly illustrates that mean reversion strategy in action on Google stock. Just look at how clear the buy signals are when the price absolutely crashes through that lower band. It's effectively catching the stock at the absolute floor of its mathematical probability. And then check out the sell signals. They pop up right as the price pierces the upper band, capturing the peak just before the price exhausts itself and inevitably swings right back toward that middle spine.
Now, conversely, when you look at this highly volatile Tesla chart, you can clearly see what happens when that 95% rule completely breaks down. Right in the middle there, the bands experience a massive squeeze, and then the price just violently breaks out. Instead of snapping back like it's supposed to, the price totally ignores the ceiling and just rides that upper band higher and higher. This perfectly proves why Bollinger Bands are absolutely not a crystal ball, they're a probability map. When a stock undergoes a huge fundamental shift, it's going to completely shred those normal statistical boundaries.
Which brings us to Section 5, when statistics meet reality. Because as we just saw, the market definitely isn't a textbook.
So here is the harsh reality check from recent academic studies. While Bollinger's original bands assumed this perfectly symmetrical normal distribution, a neat and tidy bell curve, real human emotion creates what statisticians call fat tails. Fear and greed basically skew the data. And because of this asymmetry, research shows these bands actually only contain price action about 88% of the time in the real world, not that theoretical 95%. To fix this, academics had proposed these complex mathematical adjustments called Edgeworth expansions. Basically, it's a way to factor in the real-world messiness of panic selling and euphoric buying, making the bands far more accurate for contrarian trading.
Which leaves us with a pretty fascinating final thought. Bollinger Bands provide these absolutely incredible mathematical boundaries to help us navigate the chaotic waters of financial markets. They use elegant formulas to capture momentum, volatility, and trend. But, as we've seen, when panic or euphoria really takes over, all that math bends straight to the will of human psychology. It really leaves us wondering, when we look at these charts, are we actually mastering the numbers, or are we simply finding a better way to map out our own madness? Thanks for joining me on this explainer, and definitely keep questioning the numbers you see.